We start today with the markets, stocks falling as higher rates weigh on the higher weights. Why not weigh on those markets? The 10-year yield getting above 4.9% earlier today, and that is happening as earnings season cooks up. Let's bring in Jim Tierney, AllianceBernstein's Chief Investment Officer, Concentrated U.S. Growth. Can concentrated U.S. growth continue to grow if interest rates continue to rise?
Absolutely. We're looking for companies that have real great secular growth drivers as opposed to cyclical growth drivers. So our entire purpose is to get through tougher environments. So we're not worried about what's coming given what we own today.
And where are you finding those opportunities now?
Well, Abbott's a great example, and Abbott reported really strong earnings this morning. The fear around the stock had been GLP-1 drugs and their Freestyle Libre business. We think that's an opportunity, not a risk. And you look at the rest of their base business, continues to be incredibly strong, growing double digits. So Abbott's an example. I think ADP is another example. ADP in terms of what they do with payroll processing. And if rates are higher for longer, that means great things for their float income, which will drive more and more profit to the bottom line. So those are two great examples.
Jim, yesterday there was a sense that bond yields were rising for the good kind of reasons. You know, the data was better than expected. I think it was retail sales, industrial production. Today, I'm not so sure. Is this the bad kind of rise? Is it driven by, you tell me? And so how important are figuring out these moves to the direction of the stock market into the rest of the year?
It sure feels to me like we're at a relative peak on rates. The economy, even though the Atlanta Fed GDP now number is very strong, it doesn't feel, and you saw the beige book, doesn't feel like things are accelerating here by any means. And if anything, we're seeing some signs of weakness out there. So I think rates are toppish here. When I look at equity multiples where they are in the high teens to around 20, that doesn't feel overextended. But again, it all comes back to earnings. And if you can find earnings growth, those stocks are going to do just fine from here on out.
Forgive me for asking a question I've asked a couple of times earlier this week, and it is this. If I had told you a year or 18 months ago that bond yields on the 10-year were going to be 4.9, almost 5%, would you have suspected that stocks on the S&P would be where they are today?
I don't think you would have thought that as a whole, for sure. But I think you have to disaggregate the Magnificent Seven and their impact on the performance versus the broader market. And the reality is the broader market or the average stock is flat this year after being down a lot last year. So I don't think that the average stock has done nearly as well as the indices.
So then how healthy is the stock market overall?
I think the stock market is fine in terms of when you look at where earnings are and particularly a number of companies that can do well here. I'm not worried about the select secular growers. I think the risk is in companies that are going to have disappointments, and I think the broader market might have some disappointments here. So you really do have to be selective in terms of what you own here.